Shares of Singapore-listed Yoma Strategic Holdings slid 25% after it resumed trading on Wednesday following a two-day halt due to Myanmar's military coup. This as other SGX-listed firms with exposure to Myanmar like Interra Resources and Singapore-Myanmar Investco also took a beating this week. One expert says things are highly uncertain at the moment and the business sentiment outlook hinges on the military's upcoming strategy. Myanmar-based Yoma said in a business update that its restaurants and logistics businesses have resumed operations. Its office employees have been asked to work from home for the week. It adds that it is closely monitoring the political developments in Myanmar, and it's still too early to assess the longer-term impact. One expert says foreign firms will have to brace for updates from the government and not make hasty business decisions right now.
From a financing standpoint, it'll be difficult for the SG-listed Myanmar names to function in a sanctioned environment. From an operational standpoint, it'll be difficult for them to sell their products outside the shores of Myanmar if the sanction regime is very, very strict.
Experts say the military has always played an important role in Myanmar's politics and the economy, and firms and investors would have taken that into account when investing in such a frontier market. A scenario that could pan out in the months to come may be a rollback on some military measures to not isolate Myanmar from international capital markets.
Another scenario would be that the civilian leaders return to power, in which case the impact could be minimal. The third, possibly the worst case scenario, is that Burma returns to the 88 style isolation where it is completely cut off from international capital markets. That would be catastrophic for the Burmese economy as well as its people, who are urging investors to look at it in a positive light.